live. Let's just give it a minute or two here before we kick things off to allow a few more people to get into the live stream. But I have a question for those of you who are already here. How many of you feel as if your wages are keeping up with prices? Put a 1 in the chat if you think your wages are keeping up with prices. Put a 2 if you feel like your paycheck isn't going as far as it was in the past. Let me know what you think. All right, so today's big headline that we're going to get into, and there's a lot of things we're going to talk about today, but this is the big one. Walmart stock tanks 7% as retailer warns consumers still tightening their belts. And this is an ominous sign for the U.S. economy. There are ample signs out there that we are headed towards a significant economic decline, potentially a massive recession. And what Walmart told us today is just one more sign that all is not well. But this is not necessarily bad for the price of gold and silver. And I'm going to tell you why as we go through this story and look at some of the market action. So today, Walmart had their earnings, and it wasn't so much that their earnings were bad. That part, it was lower, but it was in line with expectations. Everybody was anticipating Walmart earnings would come down. But the problem was the guidance, the forward guidance that Walmart gave for the future. They believe their earnings are going to be declining, and they believe this because the U.S. consumer is coming under a tremendous amount of pressure. So let's go over some of what Walmart said here. The CFO, John Rainey, told us that there was a sharp fall off in sales during the last 2 weeks of October. Now, sales have picked up a little bit so far in November, but of course, we are heading into a season of retail shopping. So a lot of that has to do with seasonality. There are sales. We're heading towards Black Friday. Retailers always sell a lot in November, but that steep drop off at the last 2 weeks of October should be a warning to all of us. Now, he also said that Walmart is more cautious on the consumer than they were 90 days ago at this time. And then also that general merchandise sales reflect softness in discretionary categories, including apparel, home, and toys. So people are spending more of their paychecks on just the basics: food, gas, clothing, rent. They don't have a lot of money left over for discretionary purchases. And this is no surprise because consumers have come under a tremendous amount of pressure from rising inflation, while simultaneously the Federal Reserve has been tightening credit conditions here in the U.S. Now, we can see what's happening to Walmart shares following this warning earlier today, down right now live 7.66%. So it's a far cry from what we saw occur yesterday with Target. And I see some folks popping into the chat. Hello, everybody. Let's wake that algorithm up. Thank you for joining. Smash that like button if you haven't already. And let's talk about why this is a big problem. Now, all of the major stock indexes you will see are also in the red today. And then crude oil. Look at crude oil. Down almost 5% today. Now, I want to talk a little bit about crude oil because this was a large contributor to the drawdown in the rate of inflation that we witnessed in the last CPI report. It was largely energy and gasoline that was coming down that kind of tampered or put a tamper on the inflation rate. Still 3.2% year over year, so still far higher than the Fed's target. But of course, markets interpreted this low inflation sign as meaning that the Federal Reserve may be near to tightening. Although some of that optimism seems like it is fading away today. But think about crude oil. It is down almost 5% today. And this is despite the fact that the Middle East is on the verge of a large regional conflict. I mean, attacks against U.S. forces across the Middle East still ticking up, more than 50 attacks over the past several weeks. We know that, there have been airstrikes in Syria and Lebanon. The northern border there with Israel and Hezbollah is a hot zone, and yet still the price of crude oil down almost 5%. So, what does that tell you? Why would the price of crude oil and gasoline be dropping despite that tremendous amount of risk? Well, this type of decline in the price of energy, despite the fact that the Middle East could, devolve at any moment, is a sign that there is significantly less demand being anticipated by investors for gasoline and crude oil. I mean, imagine if the Middle East was at peace right now, how far the price of crude might be falling. And this is a sign that, again, that consumers are incredibly pressured right here. They're not buying as much gasoline. They're not buying as much of anything. And, crude oil touches just about every aspect of the economy, but people are driving less. They're probably planning their trips more because gas can become a significant portion of your budget. And of course, the price of gas still significantly higher than it was several years ago. So it is a contributor to this pressure on consumers. But the fact that crude oil and gasoline are dropping today by this magnitude should be a warning to us that a massive recession is potentially on the way. Now, gold and silver, on the other hand, they seem to be reacting pretty favorably to market conditions today. Got the chart here from SD Bullion. You can see right now, price, actually, I think I need to refresh this because I think the price of silver has come down a little bit since I first loaded that chart. Yeah, there we go. Still a pretty good day for silver, up right around 24 bucks, up another almost 2%. It was up over 2% earlier today, giving up a few of those gains. But silver has been putting on gains ever since the CPI report earlier this week, the lower than expected CPI report. So first of all, I just want to comment on, what a paradoxical, bizarro situation we find ourselves in here. Think about the CPI coming in lower than expected, and then that causes the precious metals to rise. It causes the dollar to drop in value. Think about how strange that is. And to me, this is a sign almost that more inflation is basically unavoidable and guaranteed. Because think about it. If inflation moves up, what would we expect? The dollar to strengthen? I mean, that's the trend that we've seen. Higher inflation means lower gold and silver prices. And then when inflation starts to come down, the dollar declines and gold and silver move up. I mean, you would think it would be exactly the opposite. But what's going on here is that when you see inflation coming down, it gives investors the signal that the Fed is going to be able to return to easier monetary policy very soon. So, I mean, think about that. It's like inflation is going down. So now we know that the Fed is going to be able to create more inflation. And of course, in this market that we are witnessing, fundamentals are out the door. It's all just about what the Federal Reserve is going to do next. But think about what the Federal Reserve is going to do when this massive inflationary downturn kicks off. Next year is a election year. Do you really think that if we see the markets tanking and unemployment soaring and a significant recession that the Fed is just going to sit idly by? Do you think that their masters in Washington are going to allow that? I mean, even if Jerome Powell wanted to, he would just be replaced by somebody who will play ball with Washington politics. So if we do see a recession, which is looking more and more likely, then expect more up days for gold and silver. In fact, I think that the big moment that's going to come for gold and silver. I mean, they've already had a pretty good run past couple days. Look at that on the weekly chart. And gold, the same thing, by the way. Yesterday it had kind of taken a pause, but today it's back in the green, up almost 28 bucks, just below $2,000. When the Fed actually returns to easing, which I believe is inevitable, and it may be sooner rather than later if we can interpret these economic signs as meaning there is a downturn around the corner, that is going to be when gold and silver absolutely explode. And, I was buying up some mining shares. I was buying some physical bullion when silver was a little bit lower than it is right now. And after the run up of the past few days, my primary regret is not stacking more silver or picking up some more miners. It's that I didn't buy more of them, right? It's not that I acquired them. It's that I should have just allocated more dry powder. But that's how it goes. You can't time markets. But I believe that we will see a big move up in the metals when the Fed finally turns around and begins cutting, and that is on the way soon. Now, if you want more signs that a big recession is on the way, you don't have to just take Walmart's CFO's word for it. Here's one from CNBC. Average credit card balances top $6,000. Now, that's not anybody's opinion, that's just a fact, and you might not think that's that high, but that is a 10-year high. Delinquencies also rising. So this is from a report from TransUnion, one of the major credit monitoring bureaus, whatever you call those guys. And total credit card debt is at $1.08 trillion. And according to TransUnion's Charlie Wise, he says consumers are struggling to afford their everyday expenses and they're trying to keep the house of cards from collapsing. Yeah, so that house of cards is going to collapse. Unlike the federal government, consumers don't have a printing press to bail them out. Just look at the credit card debt here. Here's a chart of it. You can see it moving up. Does that look like a strong consumer to you? People racking up credit card debt to buy groceries? That doesn't seem like a strong consumer to me. It seems like a consumer that is going to default on this debt eventually. I mean, many consumers now, many individuals are forced to take on second and third jobs, despite the fact that they are working multiple jobs at a record rate. Credit card debt continues to rise. So not even these extra jobs can save the consumer. They are being forced to take on high interest credit card debt to make ends meet. And, as things continue to worsen, there's only so many jobs you can take on. You can take on a second job, maybe a third, but, beyond that, you can't take on a fourth and a fifth and a sixth job. There's just not enough time in the day. So what are consumers going to do? Also, delinquencies on the rise, as they point out here. Now, that's a problem for consumers, certainly, but it's also a big problem for these financial institutions, which are on the other side of this unsecured debt. If you default on a credit card, what recourse does the issuer have? They can't come take your house. Maybe if it's a huge amount of debt, they can take you to court and sue you or something. I mean, I'm not an expert on that. Take everything I'm saying with a grain of salt. But for the most part, they just have to write it off. And there's going to be a lot of write-offs coming, folks. And the banks and the financial institutions can hardly deal with that. I mean, they're already under pressure from a tremendous number of other sectors. You've got commercial real estate, you've got devaluing U.S. treasuries on the balance sheet of these banks. Let's look at this one from MarketWatch. This is from today. U.S. industrial output drops 0.6% in October, pulled down by United Auto Workers strike. So this was a worse report than was anticipated. Industrial production fell 0.6% in October. That's reported by the Federal Reserve. And it was anticipated that there would be a 0.4% decline. So industrial activity in the United States shutting down. What does that mean? That means more workers are going to be losing their jobs because there's not, they don't need to make the stuff, so they need to employ less people. That's going to mean wages are going to drop further. You can see how this can kind of spiral out of control. And we are on the verge of a very serious economic situation here in the US. Now, I mean, you're seeing what's going on in the markets today. You've got stocks down, gold and silver up. Why are gold and silver rising? Well, it's because ultimately investors, I think, are getting the idea here that the Federal Reserve, regardless of where inflation is at, is going to return to printing more money. Now, they'll probably manipulate the CPI. They'll be telling us, inflation's not as bad as it is. But do you really think that during an election year, they're going to allow a massive economic decline? There's no way that will happen. I mean, even under normal circumstances, that wouldn't be likely, but there's no way when unemployment begins to rise and the economy begins to fall apart that they are going to just sit idly by. Again, the bankers will be replaced if necessary. They say that they're independent, but of course the president does appoint the chair of the Federal Reserve. So they don't play ball, well, they can say goodbye. I mean, that's why they tend to do what is needed to be reappointed. I think it's a cushy job and they want to keep it. Here's one from the Wall Street Journal, more signs that banks are going to be coming under tremendous pressure here, likely going to need another bailout in one form or another. This is titled "The Clearest Sign Yet: The Commercial Real Estate is in Trouble." Now, this article has to do with mezzanine loans. These are secondary loans outside of traditional lending avenues that many of these property owners have been taking on. These are often at a higher interest rate than traditional mortgages. Perhaps you will take one on when you can't qualify for a traditional mortgage on these commercial real estate properties. But the Wall Street Journal performed an analysis that found notices for 62 mezzanine loans and other high risk loans this year through October. They're talking about foreclosures. So, as they say here, foreclosures are surging in an opaque and risky corner of commercial real estate finance, offering one of the starkest signs yet that turmoil in the property market is worsening. Now, these aren't reported the way that typical mortgages are. So again, this is a bit opaque. It's a little bit hard to find this. But what they did was they did an analysis of notices of default in publications. And to give you an idea of how serious the situation in this area of finance is getting for commercial real estate, these are the notices of foreclosure. This is 2023, higher than any other year on record, according to this analysis. And so, a lot of these mortgages are going to, I think it's like $2 trillion worth of these commercial mortgages coming mature over the next 2 years. And that is going to be a huge problem for the banks. Now, a lot of the banks, I think, have not, mark to market the properties that they have backing a lot of these loans, because if they were to do that, the whole system would likely collapse. They would instantly be insolvent. And so, certainly they don't want to do that with all of these new rules and regulations that the banks are under to maintain certain levels of capital. They can't, but that doesn't fix the problem. It just, it kicks the can down the road. It's just like with the unrealized losses on U.S. Treasuries. The banks don't have to mark those treasuries to market, the ones that are on their balance sheet. They can have huge unrealized losses on those treasuries. As long as they don't have to sell them, everything's fine, right? Well, but the problem is when they have to sell them, maybe because other areas of their portfolio, like their commercial real estate loans, are failing and they need to raise liquidity. So these loans, according to the Wall Street Journal here, took off in the decade following the 2008-2009 financial crisis as regulators cracked down on big banks and they became more conservative lenders. Many property owners made up the financing shortfall by borrowing from smaller banks, so that's where some of these mezzanine loans are from, smaller banks, keep that in mind, or by taking out these second loans from debt funds and other non-bank lenders. Okay, so I'm sorry. So the mezzanine loans are from outside of traditional financing, not from the banks, but they're saying they were relying on small banks and then also on these non-traditional, non-bank lenders, often on top of bank mortgages. And then here, lenders liked providing mezzanine debt because these loans generated higher yields, often more than 10% during years when interest rates on long-term government bonds hovered around 2%. So you can see greed having a role in issuing these obviously riskier debt instruments, just like in the great financial crisis. That was what the problem was. It was subprime lending. Well, mezzanine debt in the commercial real estate sector may turn out to be this crisis's subprime loan of sorts. And so this is not good for the banks and for the commercial real estate sector. And, this is evidence the continued pressure that is being put on these banks by the Bank Term Funding Program, the program that was set up as an emergency lending facility by the Fed back in March when banks started to fail. Look, hitting a new record high on November 8th of almost $113 billion now being loaned out through the Bank Term Funding Program. And you can expect this number to expand significantly. Remember, this is basically just QE by another name, because what the Fed is doing is they're taking these low-yielding bonds, these devalued assets at their face value and giving the banks cash in exchange. But the cash actually far exceeds the real market value of these treasuries. And so what incentive do the banks have to pay back those loans and take that collateral back onto their balance sheet? No, I'm sure they're content to just let that sit with the Fed, and that's not going to be good for inflation. The Fed monetizing debt via another mechanism. But expect a lot more of that. I mean, $113 billion dollars is going to look like chump change by the time this crisis really manifests itself. And do me a favor, we're at 250 folks in the live stream here, 95 thumbs up. If 5 of you hit the thumbs up button, we'll hit 100. That would be pretty great. And I think this information is worth spreading, so please do that. Also, hey, while I'm at it, call to action. Hit that subscribe button. Tell your friends. Post this on social media. I appreciate all of the support. It's one of the best things you can do to support this channel. So I just say a huge thank you to all of you. Now, here's another thing. This is the 4-week moving average of continued unemployment claims. So these are people who are collecting unemployment benefits, insured unemployment. You can see that this number bottomed out there in the second half of, or in the kind of the end of 2022, and it has been ticking up ever since. But now we're really starting to tick up again with unemployment. But look, this has a long way to run. The signs are there that there is going to be less employment. I mean, just wait until you hear about the seasonal employment. Those aren't going to be available this year. I'm sure the seasonal employment jobs that a lot of people rely on from these retailers, the consumer's coming under a tremendous amount of pressure, job losses, higher prices, inflation, all sorts of stuff. Delinquencies are on the rise. And yet the Fed, they keep telling us about this soft landing. Well, a soft landing is not going to manifest itself, I am afraid. I don't even think it's possible at this point. The Fed is just in a bind where they have to decide to either bail out the economy or defend the dollar. But I don't think that there's much chance that they're going to go to the defend the dollar option, and that's evidenced by things like the bank term funding program. I mean, they were pretty eager to get that cranking back in March, and I think they kind of really showed their hand. Now, have we heard about soft landings before? Yes, we certainly have. Actually, in 2006, around that time, there was a lot of talk about a soft landing, but we all know how that worked out. Now, this is a chart, let me see if I can get this pulled up here, of the federal funds rate. And to give you an idea of why the economy is on the verge of this massive recession, I mean, it's not a secret, right? When you have an economy that is as addicted to cheap money, as addicted to credit as ours is, and that's evidenced by the massive amounts of leverage across the board, consumers, credit card debt, student debt, business debt, commercial real estate mortgages, which are now coming under a tremendous amount of pressure, government debt, the interest on the federal debt just hit $1 trillion. I mean, quite incredible. No, I'm not in my basement. Thanks, Ron, though. All right, so this is the federal funds rate back in 2005, 2006. You can see they started to hike it up. They stopped because there were signs of weakness, signs of problems, kind of like what the Fed is doing right now. But what happened? I mean, we got the great financial crisis. We got a collapse in real estate. We got failed financial institutions. And what's different between then and now? Well, one, the hike in the federal funds rate has actually been more significant than back then because we were coming from zero, coming from a lower point. You can see we've actually exceeded where they got to the last time around. But what's different? I mean, all of the problems are magnified. That's what's different. The federal debt is more than 3 times what it was. Debt to GDP is significantly higher than it was at that time. Consumer is considerably weaker. Inflation is much higher than it was the last time around. So, what's that mean? Well, it means that the crisis is going to be worse this time around. And I don't think that that's a shock to anybody. I mean, none of those systemic problems from 2006, 2007, 2008 were ever addressed. They were just papered over by the Fed cutting rates to zero and printing trillions and trillions of dollars. Between 2008 and now, the Fed still on their balance sheet, they've got almost $8 trillion. They monetized all of that debt. They were coming from almost nothing on their balance sheet. They bought up trillions of dollars. Then they bought up trillions more. And then in, the pandemic, they bought up like $4 trillion worth of debt. Now they've managed to sell off about $1 trillion from their balance sheet through quantitative tightening. And they've managed to get rates this high. But I don't think they're going to be able to get much further. I mean, you can see it took a little while for things to collapse the last time around, and we're watching that lag play out here. But I think that come January, February, March, we're going to be really seeing the cracks showing, folks. There might be a little optimism over the holidays because, seasonality and retail, everybody will be out there maybe doing a last hurrah, probably just racking up a bunch of credit card debt that they don't ever intend to pay off. I think that that might be something that consumers at the end of their rope do. They say, well, forget it. I mean, I'm already hopelessly in debt. I might as well just max out the cards because I'm never paying this thing off anyway. So maybe we'll get one last little holiday hurrah here. But I think then come 2024, that's going to be the year that the cracks really show. We're going to see a tremendous recessionary collapse, very possibly. You could see stocks declining. I mean, we might even see gold and silver temporarily decline, although I think that that might not happen this time around. I think this might actually be a little different this time. I know the famous last words, right? It's different this time. But the thing is that when the Fed comes to the rescue, I think people may understand that tremendous inflation is about to be unleashed. And there may even be a rush into gold and silver. Certainly, when the Fed finally begins printing again, I think that will be the case. And so, gold and silver are up a considerable amount over the past couple days. I'd still be looking to add. I don't really like to add on days when they're up. Maybe we'll get a little bit of a pullback in the next couple of days. That might be a good opportunity to buy, but that might not manifest itself. So let me know what you think in the comments down below. Let me know what you're doing to get prepared for this looming crisis. And stay safe, everybody. Happy stacking. I'll catch you next time. Smart Silver Stacker out.